In this video, I'm going to go over 5 rules that are necessary in order to be consistently profitable as a futures trader. Now, these rules don't just work for futures trading, but also for stock trading, crypto trading, forex trading, and the like. The very first rule is to know your support and resistance levels. And so I'm going to say to you, if you're new to trading, or if you've been trading for some time, yet you're not too sure about your support and resistance levels, then I will say at this point to stop this video, click on the link at the top right of your screen and watch my videos on support and resistance levels. It's actually a playlist, so you need to give yourself time to go through the playlist, which has probably 4 or 5 videos in it. Now, your support and resistance levels are like traffic lights are to driving on the road system. Without traffic lights, or if you disregard traffic lights, you know sooner or later you're going to have an accident of some sort. Way to reduce accidents with trading, because with trading, when you have an accident, you simply lose money, or worse yet, you lose all your money. So to reduce the chances of that happening, make sure you know your support and resistance levels before you enter or exit a trade. Always buy at support. The converse of that is don't sell at support levels. Now, this is something I wish I had known early on in my trading days, but I didn't really get it until at least I was 18 months into trading. And of course, suffice to say, I lost a lot of money. What makes an area of support an area of support is the fact that there are traders camped out with their buy orders at that particular price level. The presence of buyers always increases price action. So in the case of a bearish price action where price is decreasing, but as it's decreasing, if it's approaching a support level, then it's important not to panic and sell, because there is a greater likelihood that price will bounce upwards off of the support level. Now, it's important to note that this isn't always the case in every single trading situation. That is why it's important to take into consideration other factors such as volume and RSI and the like, or whatever other indicators you're more comfortable using. Selling into resistance is definitely a skill and a habit that you would do well to incorporate into your trading strategies. What makes a resistance level is the fact that sellers are camped out at that price point, ready to take profit. Now, as price increases and approaches this resistance point, sell orders are activated en masse, which results in a drop in price. Selling into resistance as a trading strategy will ensure that you come away with gains more often than not. Now, if you haven't already heard this phrase, then now is as good a time as any to hear it. And that is, the trend is your friend. The best thing you can do for yourself to ensure that you make consistent profit whilst trading, be it scalping, day trading, or whatever form of trading you're doing, is to work in line with the trend. This simply means you go long when price action is moving upwards, and you go short when price action is heading downwards. One of the easiest ways to find out if you're in a trend is to draw a trend line. Drawing trend lines lets you know when price action reverses and the trend is broken. Of course, when the trend is broken, you want to get out of your trade. So to draw a trend line, you're connecting all the higher highs or all the high points of a range of candlesticks, or you're connecting all the lower lows or the low points of a range of candlesticks. Once the trend is broken, as is indicated by the yellow dot, and you've confirmed that break with one of your other indicators or maybe just volume, then it's probably time to exit that trade. Now, if in this situation you're a short trader, you're a short seller, then this would be the time to enter into your short trade. Following are just a few more trends that I have identified from this chart. Now, if you've been trading for any length of time, then you'll know that it's usually not a good idea to enter or exit a trade based on just one indicator, especially if you're new to the trading scene. Personally, I use the EMA, which is the exponential moving average. And with this, in order to enter into a long position, we're looking for a crossover of the smaller EMA over the longer EMA. So that would be the 5 EMA crossing above the 10 EMA. Now, technically, a golden cross is when the 55 EMA crosses over and above the 200 EMA. But whenever there's a crossover of a smaller EMA over and above a larger EMA, it indicates a reversal in trend, and it powers a move either to the upside in the case of an upward cross or to the downside in the case of a downward cross. Entering or exiting your trades on the completion of a cross will ensure that you can remain consistently profitable as a trader. Making videos can be super thirsty work, so you can help support my channel by buying me a cup of coffee. Find the link in the description box below. Also, don't forget to like and comment below, because your comments actually inform me of what kind of content you prefer and what else you would love to see on this channel. Subscribe if you haven't already, but most importantly, don't forget to hit that notification bell. This way, you get my videos as soon as I upload them. And I will see you in the next video.